wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 175, and in this episode we are reviewing the performance of the financial markets during the 35th week of 2025, and that is from Monday the 25th to Friday the 29th of August. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off in the United States, where according to the Federal Reserve's preferred measure of inflation in the United States edged higher in the month of July, indicating that President Trump's tariffs are working their way through the U.S. economy. According to a report released by the Commerce Department on Friday, the Personal Consumption Expenditures Price Index showed that the all-inclusive index increased at an annual rate of 2.6%. Meanwhile, core inflation, which excludes food and energy prices, this increased at a seasonally adjusted annual rate of 2.9%. Though this rate came out in line with the consensus forecast, it was still 0.1 percentage points higher than the inflation rate in June and was the highest annual rate since February. This latest report shows that inflation still remains above the Federal Reserve's target rate of 2%. Nevertheless, markets still expect that the Fed will lower its benchmark interest rate at its next policy meeting in September. For your information, the Fed considers core inflation to be a better indicator of longer-term inflation trends, as it excludes volatile food and energy prices. Staying in the U.S., there was a major upset for the Trump administration as a federal appeals court ruled on Friday that most of President Trump's global tariffs are illegal, striking a massive blow to the core of his aggressive trade policy. The U.S. Court of Appeal for the Federal Circuit held in a 7-4 ruling that the law that the president invoked when he granted his most expansive tariffs, including the reciprocal tariffs, does not actually grant him the power to impose those tariffs. The court said that tariffs are a core congressional power, which means that the power to impose tariffs is vested exclusively in the legislative branch, that is, the U.S. Congress. On investment and ethics, the world's largest sovereign wealth fund has exited its investment in the U.S. machinery manufacturer Caterpillar and 5 Israeli banks following a review of the company's connections with the ongoing conflict in the West Bank. The fund manager to the Norwegian Sovereign Wealth Fund, which is valued at around $2 trillion, said on Monday that there was an unacceptable risk that these companies were contributing to serious violations of human rights in the West Bank. The decision to exit these companies was based on recommendations from the Ethics Council of the fund. On Wall Street this past week, stocks fell on Friday as investors took some money off the table heading into the long Labor Day weekend. This follows from a new record high by the S&P 500 and the latest inflation data, which showed that inflation was rising even as the Federal Reserve is still expected to cut interest rates in September, as market focus shifts to the employment report that is due out next week on Friday. Even with Friday's losses, all the three major indices closed out August with solid gains, with the S&P 500 recording its fourth winning month in a row with a 2% advance in August and came to a close at 6,460, whilst the 30-stock Dow Jones Industrial Average logged in about a 3% increase for the month to pose at 45,544, as the tech-heavy Nasdaq Composite rose by 1.6% in August and eventually settled at 21,455. In the government bond market, U.S. Treasury yields were slightly higher on Friday after the Federal Reserve's preferred measure of inflation came in as expected, but was higher than the prior month of June. With core inflation ticking up to 2.9% in July, and with the Federal Reserve still expected to cut its policy rate in September, the markets are now focused on non-farm payrolls, which are due out this coming Friday. In response, the yield on the benchmark 10-year Treasury bond rose by more than 2 basis points to settle at 4.23%. And for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil fell on Friday as traders noticed weaker demand in the United States as the Organization of Petroleum Exporting Countries seeks to increase output in order to regain market share. The market was shifting its focus towards next week's OPEC Plus meeting, in which the Organization of Petroleum Exporting Countries and its allies is expected to announce an increase in output with a view to regaining market share. However, this could weigh down on global oil prices. The price of the global benchmark Brent crude fell by 50 cents on Friday to close at $68.12 per barrel, whilst the price of the U.S. benchmark West Texas Intermediate crude lost about 59 cents to settle at $64 per barrel. In the precious metals market, the price of gold rose by around 1% on Friday and was poised for its best monthly performance since April, as the latest U.S. inflation data reinforced expectations that the Federal Reserve was still on track to cut interest rates at its next policy meeting in September. As the latest U.S. inflation data reinforced expectations that the Federal Reserve was still on track to cut interest rates at its next policy meeting in September. Traders have increased their bets for a 25 basis point rate cut in September from 85% before the inflation data was released up to 89% post-data. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. The price of spot gold rose by 4.8% in the month of August before finally settling at $3,447 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where according to data released by the Kenya National Bureau of Statistics on Friday, higher prices for food and transport pushed up inflation to a 14-month high of 4.5% in the month of August. The rate of inflation rose from 4.1% in July and was the highest rate recorded since inflation hit a rate of 6.2% in June 2024. The increase in inflation was mainly driven by a rise in the price of food and non-alcoholic beverages, which increased by 8.3%, as well as transport costs, which rose by 4.4% over the past 1 year. The Kenya National Bureau of Statistics noted that the three categories of food, transport, and energy accounted for over 57% of the total weight across the 13 major expenditure categories. In the domestic foreign exchange market, during the past week, the Kenya shilling remained static versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24, which is the fourth week in a row that the rate has been at this exact same level. Meanwhile, the sterling pound was priced at 174.52, and the euro was valued at 150.43. And on the regional front, one Kenya shilling was changing hands for 27.57 Ugandan shillings and 19.36 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.21. Even though the central bank operates a floating exchange rate policy, the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by $148 million for a grand total of $10.88 billion, which is equivalent to 4.8 months of import cover. This level of reserves is still in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. However, despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this increased from 9.47% the previous week to 9.58%, but was still in line with the revised central bank rate at 9.50%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 17.1 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 28th of August, and the central bank received bids totaling to 32 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 133%. The central bank ended up accepting 31.9 billion shillings, and the results of the auction were as follows. The 91-day rate dipped just below 8% and was hovering at 7.99%, whilst the 182-day rate declined by 2 basis points to settle at 8.05%, and the 364-day rate was broadly flat as it held at a weighted average rate of 9.56%. In the primary bond market, the Central Bank of Kenya has published its prospectus for the Treasury bond issuance for the month of September. The central bank is looking to raise a total of 60 billion shillings through the sale of 3 reopened fixed coupon Treasury bonds whose terms and conditions are as follows. The first bond is a 20-year bond that was initially issued in 2018 and now has 12.5 years left to maturity. This bond matures in March 2038 and has a fixed coupon rate at 13.20%. The second bond is a 25-year bond that was initially issued in 2022 and now has 22.2 years left to maturity. This bond matures in September 2047 and has a fixed coupon rate at 14.18%. And the third bond is a 30-year bond that was initially issued in 2011 and now has 15.5 years left to maturity. This bond matures in January 2041 and has a fixed coupon rate at 12% flat. These bonds are now open for sale, with the first 2 bonds remaining open until Wednesday the 17th of September, whilst the third bond is only open for sale until Wednesday the 3rd of September. On Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as of June 2025 stood at 11.8 trillion shillings, and this was divided between domestic debt, which stood at 6.3 trillion shillings, and foreign external debt that was valued at $42.4 billion, which is equivalent to 5.4 trillion shillings. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product. And given that our current debt to GDP ratio is now estimated at about 70% of the country's GDP, this means that the government is in breach of its own borrowing target. Up next is our topical issue, and this week we are looking at the introduction of a revised risk-based credit pricing model for the banking sector. In a press release dated the 26th of August 2025, the Central Bank of Kenya announced the introduction of a revised risk-based credit pricing model for the banking sector. The objective of the revised credit pricing model is to strengthen the transmission of monetary policy, as well as to enhance transparency in lending and to promote responsible lending by aligning the pricing of credit with the borrower's risk profile. In line with international best practice, the revised risk-based credit pricing model will use the overnight interbank average rate as the common reference rate that will determine the base lending rates for all customers. The overnight interbank average rate will now be referred to as the Kenya shilling overnight interbank average. Under the current monetary policy implementation framework, the overnight interbank average rate is closely aligned with the central bank policy rate through the use of a narrow interest rate corridor that is 75 basis points either above or below the central bank rate in order to promote stability in the interbank market and enhance the transmission of monetary policy. Under the revised risk-based credit pricing model, the total lending rate will be equal to the reference rate, that is the overnight interbank average rate, plus a premium which commercial banks will be allowed to add to the reference rate, and this premium will cover the costs related to lending as well as a return to shareholders in addition to the risk profile of the borrower. The central bank had initially indicated that for all new variable rate loans, the revised credit pricing model will take effect from the 1st of September 2025, and for existing variable rate loans, the central bank said that the revised model would take effect from the 28th of February 2026. However, commercial banks immediately requested for a 6-month transition period in order to allow for board approvals and the reconfiguration of computer systems. The central bank granted the bankers' request and agreed to delay the implementation for new variable rate loans by 3 months, that is until the 1st of December 2025, and for existing loans, the banks were given a 6-month window up to the 1st of March 2026. And to ensure transparency, commercial banks will be required to publish on their websites their total cost of credit and their weighted average lending rates, in addition to the fees and commissions that they charge for each of their lending products. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends, and also help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the people who are crazy enough to think they can change the world are the ones who do. a quote by Steve Jobs. Think about it. Thank you, and God bless.